Thank you, Mr. Bordoff, and thank you all. Very, very interesting this morning. I want to start off with, again, the subject that everyone's been talking about this week, and that is Iran. We've heard several of you mention the supply disruptions, the global disruptions that we have seen in Venezuela and Libya, and certainly with the potential for Iran going offline. So the question, and I think I'll direct this to you, Mr. Satomori and Mr. McNally. We've got a 100 million barrel per day oil market. So where does the supply come from in this short term to meet the potential for a shortfall? And then if I can have you both discuss this issue of spare capacity. This is something that I have raised over the years, and trying to get a real handle on what we truly understand to be spare capacity right now within OPEC, within the non-OPEC countries. Mr. Bordoff, you have mentioned that really it's only Saudi Arabia that has true spare capacity. Your suggestion that U.S. shale oil is not necessarily spare capacity or that swing supply that's needed. So can I have a conversation about this? Where do we go if we do have this severe disruption that Iran can clearly contribute to, in addition to what else we have seen, and how does the global spare capacity factor in, and to what assurance do we have that we've got enough to take us through? Mr. Satomori.
Thank you, Chair. So the question about where the additional supply can come from in the very short term, we have to take note of the fact that the Vienna production cuts agreement by the OPEC and some of the non-OPEC producing countries, they're still maintained. And of course, they're producing a lot less than their target. And also, they're coming from the unintended production declines in countries like Venezuela. But the fundamental the agreement we understand in the last June meeting was that they would recover they will increase the production and lower the level of compliance to 100%. And so that means that there are some countries in that group who is producing less intentionally, a lot less than their capacity. So the normal expectation is that those additional barrels should come from them.
To what extent should the U.S.
Yes.
increase production play?
And also in terms of the numbers, in our most recent oil market report, we expect that those the OPEC members along the Gulf Coast, Saudi, UAE, and Kuwait, together they should have a bit more than 2 million barrels per day of spare production capacity. And also the other, the producer who can increase the production will be Russia. And indeed, we are already seeing that the Saudi and Russia, they already started to open taps in June. So the increase is already happening. So that's about the OPEC and some non-OPEC side, the participants to that production cuts agreement. On the other hand, in the United States, of course, U.S. is increasing the production at a very fast pace, the 1.7 million barrels per day in 1 year in 2018. And we expect that to continue a bit slower, but still 1.2 million barrels per day in 2019. But in a sense, the market participants already incorporated those very fast production growth in the United States. And what we are seeing right now is as I said, there's the pipeline takeaway capacity, which is somewhat preventing the further growth in the short term. Of course, we understand that many projects are going on in regions like Texas, and those pipeline projects will be completed sometime in 2019. But before that, in the very short term, it is really hard to expect the U.S. production to grow significantly before those the pipeline takeaway infrastructure issues to be solved.
Mr. McNally, anything to add to that?
Yes, Madam Chairman, this is something I thought about and worked with when I was on the White House National Security Council, like my colleague Jason Bordoff and under President Obama, working for President Bush when we liberated Iraq, and we thought very much about this. So the problem, the policy problem again, is even though it's 100 million barrels and we're only talking about a couple million barrel disruption, a small disruption can mean a big price spike and a problem for our economy. So where do you go for quick supply? Because you can't bring on an oil field really fast. The first place you want to go for something like that, if you suddenly lost 2.5 million barrels a day or 3 or 4, you go to spare production capacity held by mainly Saudi Arabia. We went there in 1990 and 91. They were a little late in getting there. Saudi Arabia provided that before we liberated Iraq in 2003. So that's the first resort. That's what the fire department is for. You call it the fire department. The problem is there is no fire department today. Mr. Sotomayor mentioned the Saudis are going up. I want to have a word about defining spare capacity in a second. But spare capacity, we almost agree, is at least very tight, if not completely absent. So the next place you go is commercial inventories. Now, back in the last 2 years, we had this glut. And we had extra inventories. So if we had to work it off a little faster, that would have been okay. We wouldn't have had to have higher prices. But commercial inventories, and we could only see them in the rich world. Now, the growing part of the world in Asia and Africa, we don't see those inventories. So the rich world's inventories are normal. The rest of the world is probably a little tight on inventories. So if we were to draw down commercial inventories right now by that 2.5 million barrels a day, it would put upward pressure on prices. So that leads us to our last resort, which is strategic stocks held in the United States and in other IEA countries, principally Germany and Japan. We, unfortunately, decided to sell off our strategic stocks to pay for budgetary expenses, so our protection is being reduced, but that's where you'd want to go. And frankly, in my view, were we to lose Iran's 2.5 million barrels a day later this year or next, and certainly were there to be an interruption in the Strait of Hormuz, 19 million barrels a day, that would constitute a legitimate use of the strategic stocks. Final word on defining spare, because folks do define it a little differently. The IEA has a higher number for spare production capacity. They have, I think it's above 3 million barrels a day, because they count oil that Saudi Arabia could bring on, but in several months. In history and the EIA, we have a little stricter definition. It's oil that you can get in weeks, 4 weeks to be exact. And on that definition, the EIA has a little lower definition. It's about 1.5 million barrels a day. The way we count it, it's even lower than 1 million barrels a day. But however you count it, it's really tight and relative to the risks we face.
Thank you.